What's up, everybody? It's Megan here with Student Loan Planner, and today we're going to talk about how to save money on taxes as a veterinarian with student loan debt. And I know these are the two of the worst topics ever, taxes and student loans, but we're going to chat about ways that we could save money. And full disclosure, this is a picture of my dog. This is he's not a Bernese Mountain Dog, but he kind of looks like one. He's a Springer Spaniel. And I've also got my second one on the next slide. So I'm doing a little selfish pick me up here by putting them off to the side for me. But so veterinarians. So factually, you guys have an average of about 285,000 of student loan debt outstanding. That's the average that we've seen with the folks that we've worked with, and the median vet salary is about 103,000 a year. Median is, it's not average. I think median is probably better than average. Averages, I think, are dangerous on like ranges. But median would probably give us a fair estimate on about how much a typical vet might make. Now, of course, there are 1,000 things that could be different about your situation, like where you live, what you're doing, specifically like your practice area, if you're a practice owner, if you're an associate, if you're doing additional hours or not. Like, there's just a lot of things that go into it. So take that with a grain of salt, but that's a median vet salary as of the past couple of years. And tuition for vet school is it consistently goes up past inflation. I think we've got a statistic of about 4.86% is how much tuition for vet school increases on a year-to-year basis, which right, that stinks because that means going to vet school is not getting cheaper. So how can we save money on the back end on both taxes and our student loans? I've got a lot of different ways that we can do that. So let's jump right into it. We've got some. So the first thing actually is not tax related. It's more so student loan related. But I'd also like to encourage you to think about your student loans as a tax on your income, because that's kind of what it is, right? Student loan debt is I would say it's a good debt, and it allowed you to do this profession, to go to school, to become a veterinarian, to do what you wanted to do with your career. And now we have to pay a percentage of our income towards the ability to go to school, right? Towards our student loan debt. And there are ways that we can reduce the interest cost with interest subsidies. So that's this first thing that I listed here, most applicable to pretty much everybody. I'm going to go from most applicable to everybody to might not be applicable to everybody. And then on the next slide, we're going to talk about things that are specifically have to do with student loans. But interest subsidies, this is a way you can reduce the interest cost on your loans. There are income-driven repayment plans that have these. And currently, right now, there's the pay plan and the save plan that have pretty attractive interest subsidies. Save is being scrutinized right now. We'll see what happens with it, but repay is what it replaced. And that plan also had great interest subsidies, where that just means that if you're paying your income-driven payment, and the payment itself is lower than what the interest cost is per month, then that plan will waive some or all of that accruing interest on the balance, which is a big deal, right? So for example, if our payment is $100 a month, our interest cost per month though is $1,000. We make that $100 payment, it goes straight to interest. That $900 is unpaid. So what happens? Well, on those plans, the save plan, for example, it waives all of that interest. So that's how we could save money on our tax on our income from our student loan payment. Now, next up, we've got things that we can contribute to reduce our adjusted gross income, which helps us save both on taxes and on our student loan payment. So with that being said, here, I might need to move my picture just because he's staring at me. Let's do that. So with the HSA, FSA, 401k, simple IRA, SEP IRA, these are all pre-tax deductions that we can contribute to through our employer or individually. And it reduces our adjusted gross income, which reduces our tax liability today. And the also the additional plus is it reduces our student loan payment, because our student loan payment, if it's an income-driven plan, it's based off of that adjusted gross income. So HSA, FSA, that has to do with health care, health-related expenses. You contribute to those guys. You can use them for qualifying health expenses, which is pretty cool. 401k, simple IRA, SEP IRA, also like 403b, depending on if you're in public service. These guys are retirement buckets that we can contribute to up to a certain amount, and that defers that income until we go to retire. And then when we take that money out in retirement, it's taxed at that time. And that just means that we don't pay taxes on it today. So that does really reduce our tax bill today. And the additional benefit to that is it reduces our student loan payment, because our student loan payment is based off of that adjusted gross income. So this is really a win-win-win in my mind. We're winning because we're saving for our future self. We're winning because we're saving we're saving on taxes. And then we're winning because we're saving on our student loan payment. Another way we could save on taxes has to do with the student loan interest deduction. This is a deduction that we can take if we make under certain income thresholds. So that is right now, if we're single, if we make under $80,000 modified adjusted gross income, we can take the interest deduction, which is deducting up to $2,500 of interest paid on our student loans. That's worth about $550 of savings on our taxes. If we're married filing taxes jointly, then our income has to be lower than $165,000 as of today. There is a range where it starts to phase out, and after the end of that phase out period, we can't take it at all. So that's one thing to note. But that is a savings that some folks could take. I put it kind of lower on the list because hopefully your income is higher than this, or will be higher than this in the future. And then we won't be able to take it, which is not a bad thing. I'm not upset about it if you can't take it because your income's too high, right? But that leads us into another option called tax loss harvesting. This is a way that we could save money on taxes proactively and over a long period of time. So this is something somewhat instant in the sense that every year we could potentially have some opportunity to use this as a tax savings vehicle, or not vehicle, strategy, I should say. But it is long term in the sense that you can do this over a long period of time and really bank up some losses to count against capital gains. So that's what this is all about. Tax loss harvesting is strategically taking advantage of losses in your investment accounts, not your retirement accounts, but your taxable accounts. Even like your high yield savings account, for example, has a gain in it that we have to pay taxes on. But if you have like a non-retirement investment account, those gains might be quite high, and we pay taxes on the gain that we have in those accounts year to year. And if we can reduce that, of course, that means paying less taxes, and that's, that makes us feel warm and fuzzy. So tax loss harvesting, what we do is we strategically take advantage of a loss. And I like to describe the stock market. So think about this. I like to describe the stock market as, and you probably have heard me say this before, I love this analogy, but you going on an escalator. So going up on an escalator to the second floor, and you're playing with a yo-yo, right? So your yo-yo is going up and down, but you're also going up long term. That's the end result. That's like the stock market in my mind, is you're going to have the ebbs and flows of the day to day, right? The yo-yo going up and down, but you're ultimately going to be going on the up and up. And the yo-yo example on the downs, that's when we would strategically sell positions that are down. And what the point of that is we can write off losses either against our gains to reduce how much we're paying in capital gains taxes in the future, or as a capital loss overall, which saves us on taxes just from the tax return. We can write off up to $3,000 a year, and you can hoard these over time to count against future big capital gains. So this is a very strategic way to save money on taxes on an ongoing basis. It's something you can do yourself as an investor. You can also work with a financial planner or an advisor on this, investment advisor. Definitely something worth considering, especially if you're someone who is a practice owner or owns real estate or wants to retire early, because that's where some of these capital gains conversations come into play, where we're going to have to pay taxes on this money at some point. So we might as well try to reduce it as much as we can along the way. And by the time we get there, when that big like lump sum event happens. So pretty cool strategy. Now, next up, I have contractors or 1099 workers. So let's talk about that, because you guys might be thinking, oh, all these like benefits up here, HSA, FSA, 401k, like I don't have any of those because I'm just a contract worker. I get 1099 income. Well, good news is you can set yourself up as an LLC or an S Corp, which is a solo corporation, or you could be an LLC and elect to file as an S Corp. And that's going to help save you on self-employment taxes. An S Corp will. This makes sense when you start making more than $100,000 a year. Keep that in mind. So once you're making over $100,000 a year in 1099 income, consider the S Corp election. That can really help you save on self-employment taxes at that point. But the other side benefit to this is you can open a solo 401k. And a solo 401k, you're able to contribute as the employee because you are the employee, and the employer because you're also the employer, right? If you're a sole company, sole proprietor, or an S Corp. And that's great because you can also make contributions to the solo 401k on behalf of the employer, which is you. But that means there's a big bucket that we can contribute to for retirement, which saves us money on taxes today and saves us money on our student loan payments. So win-win right there. And lastly, I'm going to put on here, start a practice. So some of you guys might be interested in this, starting your own vet practice at some point. Statistically, you will make more money than an associate. So that's pretty cool. But also, you'd have opportunities with a business to write off business expenses. And there's just some opportunity there to save on taxes. You'll pay more taxes if you're making more money, but there are some strategic ways you can go about saving on taxes on the business side, which could be something to take a look at if this is something that you want to entertain. Oh, there's Boone right there. He's here in real life. Those are some ways on how we could save money on taxes as a vet with student loans. But let's also talk about ways that we can save, which specifically relate to student loans, and or our tax situation impacts the student loans, vice versa. Our student loan situation impacts the tax situation. So I'm going to slide my screen over. This is my other puppy. Her name's Willa. She's a Bernedoodle. And we've got, so first up, married filing separate versus filing jointly. That's what this stands for, MFS versus MFJ. So MFS is filing taxes married separately. If this is applicable if you're married and let's say you're going towards a forgiveness path, you're paying on an income-driven plan with your student loans, and you want to keep the payment as low as possible. We need to be filing taxes married separately, or at least considering it if your spouse earns income. Because if we're filing taxes jointly, the payment is going to be based off of joint income, which is not ideal, right? We want that payment to be as low as possible. So filing separately could make sense. Now, we don't save money on taxes by filing separately, though. We save money on our student loan payments, but not our taxes. We do miss out on certain benefits to filing jointly when it comes to tax savings, but there is a crossover point where if we save enough in our student loan payments over the course of the year, it could warrant the cost difference between filing jointly and filing separately. So we've got a cool calculator on our website that you could check out to try this out. Put in your income, your spouse's income. It'll spit out an estimate for how much your tax liability might be if you were to do one or the other. And that can help you decide if filing separately is worth it for your student loan situation. We could also set up a time to chat with a one-on-one consultation, or you can chat with your CPA about this. Another way that you could save, specifically when it comes to tax-related things, but it impacting the student loans, is amending tax returns. So a lot of people don't know this, but you can amend tax returns as far back as 3 years. So let's say we file taxes married separately because it does save us money on our student loan payments, but we pay an extra like $2,000 or $3,000 in taxes, which stinks, right? We can go back and amend that separate tax return from separate to joint, and that allows us to recoup that lost tax savings from that tax year. And we could do this as far back as 3 years, right? So we do have folks that strategically do this over time. And that could be something that helps you, you kind of miss out on tax savings, but you get it back by amending. So that's called the amend and file strategy, or file and amend strategy. And last up here, I want to mention on ways that we can save on student loans, but specifically tax related. If you live in a community property state, that's 9 states here in the US, they all kind of border the Pacific coast and the Mexico border. So Washington State, Idaho, California, Arizona, Nevada, New Mexico, Texas. I was about to say LA, New Orleans, but Louisiana and Wisconsin. So Oregon, if you're looking at a map, randomly Oregon is not one of these states, even though they're like smack dab in the middle of all of these states. But Wisconsin is, so it's almost like the traded places. But community property states, they're a little interesting because if we file taxes married separately, what they're going to do is they're going to take your income together. So you and your spouse's income. So let's say you make 400,000, your spouse makes 100,000. So let's say you make 100,000, but your spouse makes 40,000, right? So 140,000 is our total income as a household. 100,000, 40,000. Then what we do if we file separately in a community property state is the federal return takes that income and divides it in half between the 2 tax returns. So instead of 100,000 on your tax return and 40,000 on your spouse's, we're going to have 70,000 on each tax return. So it makes your income look less if your spouse earns less than you, which is a huge benefit to your student loan payment. And it will make your spouse's income look more, but if y'all are looking at this holistically tax-wise, it should shake out the same as if you were filing jointly, which is good. But community property states have a lot of opportunity there, and it can't hurt you. So if you're the lower income earning spouse and you're worried about the income looking higher by doing this, community property split, that's okay. You still want to file taxes separately, but we can use alternative documentation of income to truly keep the payment off of your own income if your tax return is going to look higher. So lots of cool strategies with community property states. Filing separately is also not as expensive with community property states, which is pretty cool too, because then we're not missing out on like the tax savings to filing jointly. It's kind of the same if we look at it. So again, something to chat with your CPA about or a planner about to make sure that we're doing the right thing, saving the most money on both our student loans and our taxes, because both stink and it would be nice to save money on 2 pretty crappy things. So all that to say, I hope you're able to take a couple nuggets from this of information that are helpful. Get a plan together. That's, I think, the biggest mistake I see folks make with student loans is just not getting a plan together, or they think they're on the right plan, or they think they're saving the most money on their student loans or on their taxes, but they're missing something crucial. Even if it's like something small, but they're missing something that could save them money or time. And so I would suggest, we do one-on-one consultations. If you want some help, one-on-one help, customized help, schedule a consultation with us. That's the easy way to go about things. We can sniff out the mistakes, figure out what exactly we need to be doing, versus the harder route, which is trying to figure it out and kind of ride the waves of the ever-changing student loan world, which is we're in the midst of some changes right now, which is pretty crazy. It's been we've gotten some whiplash here lately in the student loan world, but we're here to help. So don't feel like you're alone. Don't feel like you have nowhere to go. We can help. We do this every day. We love this. And we've got lots of free calculators on our website as well. So go check that out if you do have questions, or we have free calculators, a lot of blog content on our website. We have a podcast. We have a lot of stuff that could be helpful to you. And then, of course, you've got us for consultations if you need anything. But hopefully this was helpful. Catch me in the next video. I'll have lots more content to come. And thank you so much.